We've got an aggressive submission in front of us today.
Very aggressive.
It's a concise investment analysis report arguing that Recursion Pharmaceuticals, ticker RXRX, is an asymmetric buy-the-dip opportunity.
Right, based on technical signals and a lot of institutional accumulation. I see the conviction here immediately. It's timely, it's focused.
It hits all the right points, the JP Morgan targets, the 30% short interest.
It does, but before we even get into the mechanics of the trade, there's a big issue with the presentation that we have to talk about.
Okay, let's start there then, with the packaging of this whole thesis.
My first point is this. The highly aggressive and enthusiastic tone, particularly in the title and executive summary, risks undermining the objectivity required of a robust financial analysis report.
I can see that. I mean, you can feel the excitement, the urgency, especially with the stock's recent price action.
Of course, and the report makes a strong case. It highlights the JP Morgan target, the institutional buying, but the language, it feels less like analysis and more like, well, hype.
That's the weakness, isn't it? When you use phrases like the ultimate buy-the-dip opportunity with emojis, or loading the boat.
Exactly. Massive reversal. It just signals promotional hype. And for a sophisticated investment audience, people managing real capital, that kind of language can be an instant turnoff.
It creates a filter.
A huge one. The question they ask is, why are they selling this so hard? And the emojis in a formal title, while maybe great for social media, they just reduce the perceived gravity of the research.
So the core idea is aggressive because of the risk-reward, but the delivery needs to be almost the opposite, conservative and rigorous.
Let the data persuade, not the exuberance. That's why the suggestion is to temper the stylistic presentation, maintaining the conviction, but channeling it through clear, objective financial language.
Let the numbers do the talking.
The numbers are strong enough on their own. The JPM target, that 30% short interest, the cash runway, those are compelling points. The report's strength should come from its analytical discipline, not its volume.
So how do you make that shift? How do you change the language without losing that powerful hook that's meant to grab you?
You replace the flair with formalized impact. So the title, for example, instead of what it is now, something like RXRX, assessing the deep value rebound potential at $4.
Or maybe Recursion Pharmaceuticals, a strategic analysis of the capitulation signal.
Perfect. Those are serious, but they still frame the opportunity. And then you do the same with the institutional buying.
Right, instead of the smart money is loading the boats, potentially.
You'd say significant institutional accumulation observed, or even better, get specific. Increased exposure by major holders, and then you name them, e.g. Cathie Wood, ARK Invest.
That shift alone just immediately boosts the credibility. It goes from a trading newsletter to something that feels like real research.
It really does. Because if the language smells like a pump and dump, professionals just stop reading. They're looking for reasons not to invest, and hyperbole gives them an easy out.
That's a great point. You have to earn their trust with the tone before you can ask them to accept the actual thesis.
Or of the idea.
Let's get into that. How the key elements of the trade are connected, because it really relies on this mix of technical pressure and fundamental data.
It does, and that's the crux of it, which brings us to the second major area for improvement. While the report effectively presents both the fundamental catalysts and the technical setup, the mechanism that links the two, the trigger for the potential short squeeze, needs more analytical emphasis.
Right. As it's written now, the short squeeze trigger is in one section, and the key fundamental piece, that RE4881 Phase 2 data, is in another.
They feel like two separate ideas existing in parallel.
Yeah.
And that's the structural weakness. The report leans really hard on the technical side. The 30% short interest, the oversold RSI. It suggests a bounce is coming just because of technical exhaustion.
But that's not enough for a real squeeze.
Not for a sustainable one, no. It doesn't fully exploit how the clinical data, specifically the readouts in early 2026, act as the ignition switch for all that technical pressure. Shorts need a concrete, irrefutable reason to panic. And that reason isn't technical noise, it's fundamental validation of the business.
So the argument has to evolve from this is oversold to this is oversold for a temporary reason that data is about to resolve.
Yes. Draw a much stronger, clearer line from the fundamental timeline to the technical reality we're seeing today.
Which is why the suggestion is to integrate the technical pressures directly into the fundamental timeline, creating a catalyst intersection subsection.
Exactly. Reframe it. You want to explicitly show how successful clinical data transforms that high short interest from just a statistic into, well, an existential threat for the short sellers.
So the investment thesis shifts from a bet on volatility to a bet on data resolving that volatility.
That's it.
Okay, but the 2026 data readouts, that feels a bit distant for an investment decision being made right now. How does integrating this make it more actionable today?
Because you position the current low price as a structural opportunity that only exists because the market hasn't priced in the certainty of that data yet. The thesis becomes, buying at $4 is like a premium call option on successful phase 2 data.
Where the premium is paid for by the technical snapback that data will cause.
You've got it. That's the analytical leap.
So give us a concrete example. How would you phrase that in the report's text?
Well, for the concrete examples, first you literally create that new subsection, the catalyst intersection. Then you get quantifiable. You could state that the $7 price level, which is the 200-day moving average resistance.
Right, a key technical barrier.
It becomes a near certain break, not just a possibility, a near certainty, if the 2026 data replicates the positive signal we already saw in the REC 4881 tumor reduction results.
Ah, so you're giving the technical level a fundamental justification. It's not just a line on a chart anymore.
It's the price target that validated data demands.
I see the power in that. It transforms a predictive technical guess into a reactive, fundamentally driven milestone. If the company hits this data point, the resistance breaks because the risk profile of the whole company has changed.
And it forces the shorts to cover. Instantly, it adds so much analytical weight.
It speaks to the kind of investor who knows a technical trade needs a fundamental narrative to sustain it. Otherwise, it's
Just a dead cat bounce.
Exactly. Okay, let's move to the final piece, and it's a big one for any high-conviction call. The risk assessment.
The most critical part. If you're advocating for aggressive accumulation, you have to be brutal about the downside.
And I'll say, the analysis does a good job with the financial risks. It cites the big cash runway, $785 million through 2027.
Right. It dismisses the near-term dilution and cash burn arguments very effectively. It addresses the typical short seller narrative.
But then it just stops.
It stops. And that's the third point. The risk assessment, particularly in the conclusion, primarily addresses financial risks, but needs to quantify the greater, defining risk inherent to an AI biotech company: clinical failure and platform obsolescence.
The weakness here is pretty clear. The conclusion frames the risk-reward almost entirely on price. Risk about 50 cents of downside to get, $7 of upside to analyst targets?
It's a massive oversimplification for this kind of company. It fundamentally underestimates the real bear case.
Yeah.
That 50-cent downside only holds if you assume the market is just being emotional. But what if the sell-off is rational? What if the $4 support level breaks not because of market noise, but because of a catastrophic failure of the core science?
That's the existential risk, right? If the AI model fails to consistently generate validated drug targets, the entire valuation collapses, no matter how much cash they have.
That's the systemic risk, not just one drug failing, but the whole platform. And you have to address that. So the suggestion is to introduce a high-level, qualitative discussion of the specific fundamental outcomes that would invalidate the AI-first discovery model, forcing the price way below that $4 floor.
And doing that, paradoxically, actually enhances the credibility of the strong buy call.
It does, because it acknowledges the fragility. A really strong analysis admits the possibility of the whole thing going to zero, and then explains why the analyst believes that's a remote possibility.
Okay, I can almost hear the pushback, though. Doesn't talking about catastrophic failure dilute the conviction? Doesn't it give the bear case too much power?
No, it gives the sophisticated reader the respect they deserve. They already know this risk is binary. By defining that catastrophic scenario, the platform is just flawed, and then explaining why the available evidence, like the early REC 4881 signal or big pharma partnerships, suggests that risk is manageable, you establish honesty.
You show you've considered the ultimate failure mode, and you're still bullish.
And you still arrived at this conclusion, yes.
So how do you do that without getting lost in the weeds of bioinformatics? Keep it focused on the investment implications.
You keep it focused on validation and replicability. For the concrete examples, you could add a rhetorical question right in the bear trap section. Something like, what if the positive REC 4881 data is merely an outlier and future readouts fail to consistently validate the core AI model?
That question alone captures the entire clinical risk.
It does. And then in the verdict, you refine the risk definition. You state explicitly that the 50-cent downside risk only applies if clinical progression remains steady or fails without platform implications. Then you contrast that with the risk of a platform-wide failure, which would justify a much deeper drop, maybe into the $1.50 to $2 range.
That distinction is incredibly powerful. It clarifies the analyst's core assumption. The strong buy is a bet that the risk is programmatic, not systemic. Making that explicit gives the reader a clear, defensible reason to agree with the trade.
It demonstrates that you've mapped the full downside spectrum. You're not recommending this blindly. You're recommending it with full awareness of the binary nature of this kind of investing. That's what institutions need to see.
This has been a tremendously insightful look at this RXRX analysis. The core thesis is aggressive, it's sound, and it makes a good case based on market mechanics and institutional interests. The foundation is absolutely there.
It's excellent, yes.